Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Hope you all had a great Memorial Day weekend as we kick off, and it will hopefully be a great summer for everyone. We got a few topics to talk about here as we follow up from Labor Day. We're going to go back just before Labor Day and talk about the EU. As we kind of work through some of the deals with China, EU has become the next trading partner to go through rounds of negotiation, kind of break that down, and more importantly, how the market has viewed it. We'll take a look at Chinese exports, and then Andrew's going to take a look at bond markets. Drilling into the European market response. It was kind of a surprise announcement late last week. There was a Trump announcement that we would be putting in a much higher tariff level into Europe, and much like we saw in early April around Liberation Day, markets began to sell off really rapidly. This is the Euro Stock 600, one of the primary indices of a variety of European stock markets. And as you can see, it dropped quite a bit, but it took minutes, not days or weeks to recover like we did back in April. As the market begins to adjust to become accustomed to the way negotiation tactics have worked, the belief is that much like we did with China, there'll be a much lower end result there. And as a result, the market volatility not lingering as long, which is a good thing. July 9th still stands as a critical date, as many of these deals or tariffs have been postponed until they can be renegotiated up around that time frame. So a potential area for volatility there, but the market has certainly adjusted the way it handles some of these shocks. I got sticking with global trade. The next slide here is going to show you something that I found interesting, which is Chinese exports, which actually have reached an all-time high. So the blue line there is all Chinese exports, and the black line are Chinese exports into the U.S., which have been falling down over the past couple of years and rolling back over here in 2025. So we'll see after some of the dust settles on the tariffs, but I found this interesting. Now, there's two things at play here, one of which is very much the Chinese exports could be ultimately landing in the U.S. Their trade with Mexico has surged, but a lot of that is to slap a final product or make a final tweak before the final product comes into the U.S. at a much lower tariff burden. So a lot of that could be ultimately destined to the U.S. Some of it could be just changing global trade patterns. And the Chinese, as the slide title says, may be finding other trading partners to pick up some of the slack that's falling off from the U.S. So that's a little bit of trade update for you. Turning over to markets, and Andrew will show up some of the developments on the bond side.
Yeah, so a unique shift. Normally, I'm always talking about the equity markets, but this year has been really important in fixed income. And Adam's talked about this in many different market carvers, but I found this chart really interesting. Something that we've talked a lot about, and Adam touched on here today as well, is foreign markets. What's going on in foreign economies, looking at trade has really been a big topic in 2025. And we've talked a lot about that on the equity side, where we've started seeing a lot of international markets begin to rise relative to the US, something we hadn't seen for over a decade. Not only is it happening in equities, but we're seeing something really interesting happening internationally in the fixed income market. And what this is looking at is how other markets are performing since the US yields bottomed. And as a reminder, when we start seeing yields and price are inverse of each other. When yields start to come down, that means prices of those bonds are going higher, and in the inverse, when yields are going up, that means the bond prices are going down. And so what we often see is that we see often a pretty high correlation for a lot of emerging markets as they respond to what U.S. treasuries are doing. So if we can zoom in on this chart, what we can look at on first is the far left side. And what this is looking at is how different emerging markets, but fixed income, have responded or have risen or fallen since we saw the bottom in U.S. yields. And as you can see, we saw a lot of these have actually continued to go down in yield, meaning that the prices are going up. And in fact, we're seeing a break in correlation as well. If we look at the right chart for emerging markets, only Mexico has a 3-month correlation in excess of 0.4, meaning almost half of the correlation. Many have actually gone negative, meaning that we're seeing a breakaway from other countries trading in for their bond markets like the US. So the reason that this report where this chart came from for that is we're starting to see a big shift in how their economies are handling debt. You saw, if you watched the market cover last week, we talked about the downgrade. If we start looking again at international markets, there's projections for a much smaller fiscal deficits as a share of their GDP than in the US. You're seeing less inflation concerns, with some of their CPI, consumer price indexes, actually going to year-over-year declines in many emerging markets. And there's also, again, just that lack of correlation between US rates and emerging markets as we start seeing debt concerns become more of an issue in the US and less of a response to really tackle some of that debt. We also see from a valuation perspective where valuations are increasingly distinct and independent from US assets. And so it's creating a much more tradable market where you're seeing a lot more distinction, and the lack of correlation creates opportunities for investors like us to find different opportunities to maybe take advantage of some of those breaking correlations, some value opportunities, as not everything is showing a strong tie to just whatever was happening here in the US. So pretty interesting. Something is definitely changing in fixed income internationally that we definitely want to keep an eye on.
Yeah, thank you, Andrew. Good stuff. And another reason that these assets should be looked at. In my opinion, I think there's a pretty wide gap between people's perceptions of emerging market bonds and their true raw fundamentals. And this helps bring that to light in a data sense. So thank you for that. And thank you to all of you for giving us your time. Sure appreciate it. If we can be of service, please don't hesitate to reach out, 800-928-4001, or scan the QR code and do so electronically. Thanks. Have a great weekend.